Okay, good afternoon. Welcome back to our Monday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we have quite a bit to offer you and a lot of things that we want to go over. Patrick will be joining me here in a few minutes. So looking forward to having him on and discussing some macro views of the Canadian markets, the dollar, commodities, all those things. We're going to be discussing those things with Patrick. So as I said, he's going to be joining with us here in a few minutes. Once he logs on, we'll be able to go over those things with Patrick. So in the meantime, we're going to go over some charts and take a look at from a broader picture of what our views here for the markets are. Before we get started, what we're going to discuss here today is purely for educational and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today what I'm going to do is I'm going to share with you my charts, my economic research, and the different trade ideas that we're currently looking at in the markets, mostly from a macro perspective, but we're also going to talk about a few equity names that are moving in this particular market, and we want to talk about what directional views that we have, and we'll bring in Patrick to ask him his thoughts here as well. Let me move 1 second here just to make sure that I have this up and running. Okay, let's go ahead and get started. So like I said, Patrick is going to be joining me here in a few minutes. Now I'm going to pass the slide for now. I'm going to come back to this when Patrick joins us, and we'll be able to discuss some of the things regarding Patrick's background and the discussions that we'll have with him once he joins. So we're going to start off as we normally do, talking macro, talking big picture about the Canadian market. So first of all, we talk about XIU, which is the first major TSX 60 index. Now, one of the things that we do want to update you is over the past couple of weeks, TSX 60 continues to grind higher. And what we see is that momentum continues to confirm these new moves higher, which tells us that the health of this market rally is fairly strong. We have both on the daily and weekly charts, strong positive money flow, and as you see both on the daily and weekly charts, as the market continues to move higher, momentum continues to confirm those moves higher. This is signs of a fairly healthy market rally. This leads us to believe that even though markets are nearing overbought, that doesn't necessarily mean that they're going to correct lower. So we see that the health of the current market rally to actually be fairly strong, which is in a direct comparison to the US markets, which is not quite the same. We're actually seeing slightly different views here from the US markets. But first, we're going to take a look at Canadian banks, because Canadian banks, as of right now, is looking like they're starting to break out to the upside. Now, the question from my perspective isn't necessarily the breakout itself, but more importantly, is this rally sustainable? Because we did see one prior rally here back in early June that failed. And the question is whether this current rally is also going to fail, especially you have the 200-day moving average coming in at around 35.75. You have this recent all-time high here around 35. So you have a lot of resistance in this 35 and a half range here. So you have a potential area that this rallies to, but could potentially stop and continue to move lower. The reason that I'm not as bullish here on the banks is predominantly due to interest rates being so low. I find it difficult to have a fundamental thesis as to why banks should continue to rally for much longer, other than maybe some short-term positioning and short-term optimism from economic numbers that we're currently seeing across the board, both in the US and Canadian markets. But like I said, if you compare the Canadian versus US markets, there is one difference here, in my opinion, predominantly around the fact that in the US equity markets, as we continue to push new relative highs, this is the S&P 500, one of the things is that the momentum indicators hasn't really confirmed a lot of these moves higher. So there are some concerns about exhaustion as markets continue to reach these slightly overbought territory, that you do have a higher risk of a pullback here, especially after quite a few weeks of just continued move to the upside without any real consolidation or pullback here like we saw back here in early June. We usually want to see markets move not in a straight line, in my opinion, but when they move straight, higher like this, you want to see some consolidation before it can continue moving higher. So those are some of the hallmarks that we're currently looking at in the US market, some of the concerns that we have. But just keep in mind that just because you might see some negative divergence, you might see things overbought, does not mean that markets can't continue to be overbought for quite some time. As we saw here back in November to February, as we can see, markets look very similar to what we saw back here in November to February. As they continue to reach all-time highs, what we saw was that momentum indicators could not confirm these new highs. That's a sign of exhaustion. But keep in mind that exhaustion in itself does not signify a reversal. It just typically means that the longer that goes on for, the more severe and the faster and the more violent the pullbacks, generally speaking, are. Now, what is the catalyst that's going to cause the next pullback, and how big is that next pullback? That's yet to be seen, but it's just important to understand and recognize the risks that we're heading into as markets continue to rise here. But like I said, Canadian versus US markets, Canadian markets looking a little healthier. Another metric that I wanted to take a look at was looking at the performance of the Canadian markets to the US equity markets. Now, the makeup of these two markets are very different. US, very heavy on technology, a lot of biotech, not a big energy industry, versus Canada, not a big technology, not many biotech names, but a lot of energy names. So because of that, what we have seen is a significant long-term underperformance of the Canadian markets versus the US markets. And as you can see both on the daily and weekly chart, that trend is fairly strong and consistent. But what we have noticed here is since the beginning of June, the Canadian markets have not continued to weaken. It actually has moved sideways. And the question is whether or not this is going to start reversing, or it's just going to continue in the direction that it normally does. Now, it's yet to be seen, but if you look at XIU, it hasn't underperformed here for the past 2 months now, almost getting into the third month of no underperformance. Now, this comes down to some of the economic numbers that I'm going to show you here in a few minutes, but largely, this is one of the things that is somewhat encouraging about the Canadian markets, especially when you look at XIU versus SPY performance. It is at least keeping pace with the S&P 500 here for the moment, but it is one that we're watching. We'll keep updating you here on this metric as to see if we are starting to see some outperformance from the Canadian markets, especially if energy really starts to outperform again, which we've seen energy become one of the strongest sectors. Today, it is up quite a bit along with industrials and energy, the strongest sectors here today. But if energy can sustain this leadership, that is where we could potentially see, if technology starts to underperform and energy starts to outperform, we could start to see XIU perhaps start to see XIU outperform the S&P 500 versus continuing this underperformance. So this is one key theme from a macro perspective that we are paying attention to here from the US versus Canadian markets. I did want to update us on employment numbers. The last time we updated this number, we were looking at the June numbers, which are particularly strong, almost 1 million jobs added in June alone. July was still a pretty strong month, slightly under 500,000 jobs. So we've had 3 months of consistent employment growth here since April, May, June, July. Fairly strong here, and you can see this across the board. You have, like I said, about a little over 400 million jobs added total, most of them coming from the service producing sector. But as you can see, almost all sectors in the green, with the exception of a few that lost roughly about 20 million. The rest of them were less than, 20,000. Most of them were under a couple of thousand or 3,000. So not a significant move, but overall, employment numbers looking fairly strong. Not as strong as June, but July looking fairly good. Now, one of the things that I do think is worth pointing out is the shape of this recovery, right? So many times we talk about a V-shaped recovery or a U-shaped recovery. So what we are starting to see here in terms of Canada is a fairly strong V-shaped recovery. Now, we obviously do expect this to slow down. We don't expect this to just run straight back up. But the Canadian markets are right now about 1.3 million jobs away back to where the pre-COVID-19 levels. 1.3 million jobs is the number that we're currently looking at. at this pace, if it can continue to add at these paces, economists are trying to figure out how long it takes to get back to pre-COVID-19 levels, but also we have to factor into some of the slowdown that we expect to see here at the end of this year. And perhaps whether we get a slowdown and whether it starts to continue moving back lower is a question for the second half of this year. So we are paying attention very heavily to employment numbers, but the fact that Canada's COVID-19 numbers are substantially better than the US, this is one part of the economy that we do expect to see outperformance of the Canadian markets versus the US markets, looking for that outperformance here. And I think that, and that's part of why I brought up that chart to take a look at Canadian equity markets continuing to, keeping pace with the US markets, which is something that the Canadian markets have not done for many, many years. So the question is whether, due to Canada's better COVID-19 numbers and better response to COVID-19, are they going to start to outperform from an equities perspective? That is the question. And looking at the employment numbers, they are looking fairly strong here. And that's part of why we're looking at some of these economic numbers. Now, the big headline here really is the dollar. This is something we've been talking about for quite a few weeks, and I wanted to update us on the dollar. So this is looking at the dollar index on the US exchanges. And we talked about this when the dollar index started to break below the $96 level. This is significant because 96 has been a strong support level since the beginning of 2019 for a long time. And they finally broke below this level here just a few weeks ago, and it's continued to weaken. This has been driving a lot of the weakness we've seen in the movements that we've seen in the markets here for the rally in gold, the rally in silver. Crude has not moved a whole lot, and that is some of the concerns that we have about crude energy as a commodity, and the rally here that we're currently seeing in the energy space as to whether that's sustainable or not. But the one thing that we also wanted to point out here is that the weakness in the dollar is something that we brought up and has continued to weaken. But over the past couple of weeks, the dollar has not weakened, and during this time, this is when we saw some of the biggest moves from gold and silver. So the question here, from my perspective, is number one, is the dollar going to continue moving lower? I certainly think that there is further room for the dollar to continue moving lower, and I especially like this consolidation that it's had for the past few days or past couple of weeks, and because that is the type of consolidation that we need to see before we can see a continuation lower here. So it looks like Patrick just joined us here in here, and I'll give him a minute here to log in and set himself up. But Patrick, once you're ready, just feel free to unmute yourself.
Hey, how are you?
Hey, good to have you, Patrick. So let me just finish up this one slide and I'll introduce you in 1 second, okay? So we were just talking about the decline here in the US dollar and the recent underperformance of the dollar, but the recent consolidation here for over the past couple of weeks, and the question is whether a dollar can continue to move lower, and that obviously has ramifications for gold, silver, any of the commodities that we're here to talk about. So before I go any further, Patrick, I'll give you a few minutes just to introduce yourself a little. Patrick and I, we've known each other for quite a few years. We've through the Montreal Exchange, but Patrick, you are the chief derivative market strategist at Big Picture Trading. We do a lot of podcasting through Macro Voices and Market Huddle. So why don't you give everyone here just a couple of sentences about your background and what it is that you do here in the Canadian markets.
Right, and so I am a Torontonian, and I've been obviously following the Canadian markets throughout most of my career, and had the opportunity to trade at CIBC for close to a decade, and then I spun off and began a number of services, including what is now Big Picture Trading, where we educate people on how to utilize option strategies with understanding how the whole market works and how to build it. The best way I describe it is that we use a top-down approach of understanding the macro conditions of the market. We use technical analysis to identify the when and where things are actually happening. And we use the options as tactical and strategic tools in order to implement asymmetric trades, ways that we can manage the risk and put ourselves in a position to profit from those moves. And so, that's what we seek to always do. And I have had the opportunity for the last decade to be working with the TMX Montreal Exchange as an instructor, and had the opportunity to host both Macro Voices and the Market Huddle podcasts. And Tony, you joined me on that Market Huddle podcast. We had a pretty good time. So it's just a great opportunity for me to always be sharing my knowledge and expertise with whoever wants to listen.
Well, thank you so much. And I think that everything that you've spoken about, we're going to touch up on everything from technical analysis to macro perspective, as well as, more importantly, how do you actually position yourself using options in this particular market? Because I think that there are some risks that we currently see with this market, and options is a great tool to help you manage risk in this particular market environment. So Patrick, just, I've already gone through a bit of the technicals of the US versus Canadian markets. We went over XIU, where we're currently trading. We looked at the S&P 500. And I talked a little bit about the underperformance of the Canadian markets that, we've seen over the past multiple years, and we're starting to see some of that underperformance. The Canadian markets actually keep up with the S&P 500. So, do you have any thoughts on that? First of all, regarding the underperformance of the Canadian markets, and whether you expect to see maybe the Canadian market start to catch up and perhaps even outperform, given the fact that Canada has had what looks like a much better response to COVID-19 and potential recovery from that.
Now, the one thing that Canada's got been helping it out is just the impact that Shopify, as a Canadian company, is had on the index, as it's one of the largest market caps now in Canada. But the one drag that the Canadian market continuously has is that the composition of its sectors and industries we're just not positioned to where the money was flowing. So a very large component is energy, and a second component is banking, which have been two sectors that have been generally lagging. And in order for the Canadian market to either catch up or even outperform the U.S. markets, we would need to see sort of those value and sectors really start to shine. And then we saw small caps in the U.S. starting to perform, even a couple little breakout attempts on some of these banks. So maybe there's a chance that we see an impulse here. But right now, what's been working is those the momentum stocks are really driven by these technology names, which Shopify is a part of that basket. And until we see rotation come back into other sectors, then I'm a little suspect on the Canadian market.
Okay, that's very good insights. That's exactly what I was talking about. It's just the composition of the U.S. versus Canadian markets, very, very different. And energy looking pretty strong here today. Canadian banks looking like they're starting to potentially break out here. So those are some of the things I want to discuss with you. But we just talked a little bit about the employment numbers in Canada, looking fairly robust. Almost 400 million jobs added here in July, pretty much across the board. The recovery so far in terms of employment in in Canada is roughly half of the number of jobs that are lost here versus the U.S. We've only recovered about a third of the jobs that were lost. So employment numbers here in Canada looking a little stronger here than the U.S. And we were just talking about the dollar, and I'd love to get your thoughts here on the dollar. I don't know if you follow the dollar index or not, but it's certainly one that we've been paying attention to a lot over the past few weeks, especially as gold, silver, sparked that rally as a result of dollar coming off. Any thoughts here on the dollar index, given the fact that it's paused a little bit here over the past few weeks while we've seen some of the biggest moves in gold and silver? Do you expect dollar to continue moving lower here after this consolidation range?
Well, there's no denying that there's a very distinct downtrend in play. And even though we've paused on the short term, I think it's a little premature to already be confirming as some sort of bottoming formation and a new uptrend. That's very, very premature to jump to any of those conclusions. For gold and silver to continue, it would be a very helpful tailwind for the dollar to continue its decline. And that would, when you look at that weekly chart you have there on the on the left there, we can see that even the lows that happened back in, well, I think that was 2018, 19, something like that.
Yep, 2018.
Yeah. So we had a scenario where those lows were, it's entirely possible that we could go down there. It's not out of the realm of possibility. And so when you have a scenario where the dollar's in this kind of a downtrend, we want to respect that prevailing downtrend. It is a huge tailwind if it continues to break down on a number of different, it's not just gold, but broader commodities. Generally, there's somewhat of a transitory inflationary impulse that comes from a weak dollar, and that tends to have almost an immediate impact on many commodities. So that could cause copper to break out further. It could cause many of the other commodities, maybe even oil heading to $45 to $50 a barrel is not out of the realm of impossibility in a weak dollar environment. I think one of the biggest macro questions to answer is that enough selling on the dollar? Is it paused? Is it going into the elections? Are we going to see a stable dollar? Or is there another big move? I think that's, if you can solve that puzzle piece, it will tell you a lot about how your composition of your portfolio should look, right?
Yeah, absolutely. So, we talked about gold and silver. That's obviously made a big move as a result of the dollar moving lower. We had not seen crude make a big move here. Any thoughts on that? I was expecting crude to move a little higher. The fact that it really stays in this $42 level is concerning to me as far as for the recovery here for energy. Energy up 2% here today. But I really, I find it hard to see energy sustaining any type of rally here, especially with crude staying put here around 42. Any thoughts on that?
Yeah, it's interesting that the energy stocks actually went through a correction while oil didn't. And so while oil stayed in this incredibly tight range, almost like a little purgatory of just a $2 trade range that seemed to last for months, many energy companies did full retracements of their prior rises off their March lows. And I think one of the most important things to watch is whether or not crude can break out. Right now, I like to always look for RBOB gasoline to get to confirm whether or not it's breaking. At this stage, gasoline is relatively weak. It hasn't been able to make rally stick, and we've seen crude here try to rally on a number of occasions and can't hold it. And so a pause and a retracement in oil is not out of line. But I'll tell you, it is a huge tailwind if the dollar breaks. I mean, if we saw the Dixie heading down to the 90 handle down below, it may be sufficient of an impulse that could cause the crude oil to break higher. I'm not trying to make that as my market call, but that certainly would be the response I would anticipate if we did see the dollar continue to, especially if it accelerated to the downside at the pace at which it's selling.
Yeah, I'm just surprised that crude hasn't had that move at all, as a result of dollar moving lower. And I think that speaks more to the weakness of crude, versus, we've seen gold and silver rally substantially, arguably a little too far, too fast, right? We're seeing gold and silver both pull back here today, gold down to 190, silver actually holding fairly well around 26 or so. I mean, what are your thoughts here on silver? We've been talking about silver having a lot more room to grow. I remember talking about that when it was trading at 17, it was trading at 21, it was trading at 23. Now it's trading at 26. First of all, it did go faster than I expected to, right? Question is for you, do you think this rally in silver is sustainable? Do you continue to chase this?
So I am structurally a gold and silver bull. I believe that on those weekly charts that you have over there, that that 5-year trade range is now broken out and a new bull market that can last years is underway. With that said, what everyone needs to do is pause and recognize that chasing silver higher has some risks, particularly like if you go back and look at 2004, 2006, 2008, each time there was these rallies in silver that saw silver double in its price. Each time we saw silver make a big move, and then each time it had a correction of like 30% or more. That was a primary uptrend. That's for years lasted and took silver from basically $5 to $50 over a decade. But there were a number of times where silver just mean reverted and just gave back a chunk of the advance. And so after such an extended rally, even if on the interim we attack on, $3, $4, $5 on the upside, which is entirely possible on this, at some point we're going to have a pause and consolidate, in this kind of parabolic bull run that we're seeing is going to just backfill. And that's something I think is very much on the table, which one of my favorite ways at this stage of implementing silver trades is to look at even whether you're using silver miners or whichever, but you're looking at doing bull call spreads, because at some stage you want to ride the momentum, allow it to keep profiting on the upside, but have a much smaller capital outlay so that when a correction begins, you have the ability to have a very small risk outlay and therefore still had some asymmetry in the opportunity. It's hard for me to justify just buying equity here or even the precious metal in its current form without, because it's just the downside of a pullback is equal to the upside potential at this stage on the most immediate 1 month interim period.
Yeah, so I think it's really important for us to discuss kind of directional views, but I think it's even more important for us to discuss, how we're structuring these trades, and specifically, whether you're talking about equities or any of these gold and silver moves that we've seen over the past few weeks that have just gone absolutely parabolic. How do you continue to position for upside? Because it's really difficult to fight this bullish trend, right? It's almost impossible to find shorts in this particular environment that lasts more than 1 to 2 days. So how do you continue to push for upside, but do so in a way where you are truly limiting your risk? And that's really where, at least myself, and it sounds like you as well, Patrick, turn to option strategies that allow you to play for further upside, but do so in a way where you're risking a very small percentage of the stock or ETF's value to play for that continual upside, using bull call spreads, as you said, because bull call spreads is one of the most efficient ways to take a bullish view of an underlying stock or ETF with arguably some of the smallest amounts of risk possible. So even Barrick Gold, one of the largest mining companies, trading at $38. Mining companies are very volatile, right? We usually think of miners as almost like a leverage play on gold here. So going out to September, buying a 38.44 call vertical, that's already almost $1 in the money, only costs you $2.15. And just to put that into context of a $38 or almost $39 stock, that's risking around 5.5% of the underlying stock price to take this bullish bet going into the September expiration, which gives you about another month and a half. Now, a gold miner risking about 5.5%, that's a relatively small percentage of the underlying stock's value to take a bullish view in a company that's fairly volatile. So
the one thing I'll add to that, like, first of all, I'm a big fan of the spread. What a lot of people that are engaging the trade need to, a lot of people ask, well, why don't I go out to October, November, December, just go out like farther in duration? And while you can look at the pricing on the surface and it doesn't look that much more expensive, the one thing that you always have to remember with spreads is that you can't reach your max profitability without reaching the expiration date. And so the little trickier part of spread trading is that generally you have to be right about the direction and the time frame from which it is to reach the max profit. You can always be profitable, but not max profit. And so I always caution of adding too much time onto a spread. I like especially when you're, let's say, looking at technical analysis on daily charts. A daily chart typically is forecasting the most immediate move over the next, let's say, 1 month to 6 weeks. And so unless you're going to a weekly chart and you're looking at like something that could develop over a half a year, you're better off making sure that you kind of match the time frame on that spread a little bit better. How do you look at it, Tony?
Yeah, so I completely agree because, as you said, one of the challenges, if you will, of trading longer term spreads is the fact that if the stock does rally in the short run, longer term spreads will actually give you a slightly lower return because the short leg will actually offset a lot of the gains of that long leg. So my preference is to buy. Usually go about 1 to 2 months out. So September 18th is 39 days out. And if the trade goes in my favor, even if it goes to the upper strike, at that point, what I'll do is I'll roll it up and I'll probably roll it out to October. So what we generally want to do with these types of spreads is as it starts to go in your favor, especially in this market environment where we do see a larger risk of a pullback, especially on gold or silver, if you start to see gains on some of these spreads, roll them up relatively frequently because that allows you to lock in some of the gains, but still play for continued upside, especially if something that moves as fast as gold and silver. Those are the ways that I'm currently playing those types of strategies.
Yeah, definitely rolling before it goes in the money is always beneficial. You want to be somewhat active. Now, what is, you were suggesting rolling up in terms of strike, but sometimes even the bottom end of the strike, rolling it in the money and just rolling up the sold strike. Now what you're doing is you're just rolling that intrinsic value and continuing to have a little bit of a higher delta on the way that it's appreciating. But you're absolutely right. Like you want to have, there's different ways to approach it. The key is that if you see that the chart remains very bullish, and the problem you have is that you're making too much money too quickly and the stock is going in your favor, you just have to have some flexibility to be able to adapt that. And often, even what I've done in the past, Tony, is I'll leave the original spread and just open a new one. So let's say we had $100 stock and I opened 100 to 105 bull call spread. As it's approaching 105, I'll just leave the original one and open a new 105, 110, and with a little farther duration, and just keep buying more upside through a new spread and leaving the original intact. Now, the risk, of course, is that you lose your profits if you get caught in a correction, but there's different ways of leveraging up if it's working, right?
Yeah, so the possibilities really are endless from my perspective of when a trade goes in your favor, and many times this is really where I do think it's worth taking the time to look at the different options that you have to roll a trade that's going in your favor into what I call taking a small win and turning into a much larger win. Versus many times I do find that many investors, instead of focusing on trades that are going in their favor, they spend too much time working on trades that go against them, meaning how do I prevent the small loss and turning that into a small winner? And as a strategist working, and you've been working as a strategist for a long time, that's a really slippery slope. I've seen a lot of investors who, a trade goes against them. Instead of just cutting their losses and moving on to the next trade, they do other things like add on more risk to try to get back to break even. So I think this is a really interesting discussion. I think it's a discussion worth having regarding, what are your best practices for managing risk to the downside?
Well, what you were saying is it's so important. I've had the opportunity to train thousands of traders over the last decade, and the characteristics of those traders that either give up on trading or simply struggle to find success are the ones that struggle to manage risk versus profit potential. One characteristic I've commonly seen people that struggle or get stuck in the mud in terms of getting any returns is they take too big losses and they cut their profits too quickly, and the profits simply you have to have too many wins to crack those big losses, and you just can't seem to get your portfolio moving forward. And learning to optimize where you're cutting losses quickly and allowing profitable trades to make you big money is so important, in terms of becoming a successful investor and trader. And that optimization isn't easy. I mean, we all seek to do that, but even just recognizing that that's what you have to do is so important. And just learning, and this is what I love about options is that we can define the risk when we get into a trade. One of the traps that almost happens always to us as investors is that we have a sunk cost in a stock that we really like because we've done our research on it, and we've learned everything about it. And as soon as that stock starts to go down, we say, no, I'll wait till it comes back to get out. And then you have no way of defining that risk. And then that just drags in your portfolio and eats away at your the market value. And it becomes a psychological burden. You lose your ability to make good trading decisions because you're just staring at this one stock that is just wrecking your portfolio. And what I love about the options is that, look, we know that when I get into a trade, if I say I'm sizing my risk so that I cut a $5,000 loss if it's wrong, then I've defined that risk in advance. And if the trade didn't work, then it's like a paper cut. I've cut out of the trade, and it's a loss that I take. But it's a paper cut. It's something I'll be able to recover from and make it back in the next trade. And it's so important to develop that discipline of being able to manage your trades that way, right?
You're absolutely right. And I think this is probably by far one of the most important and one of the probably more difficult lessons to learn as a trader as to how to think big picture and think about your portfolio as opposed to each individual trade. It's kind of, for those of you that follow, Simon Sinek, it's the difference between infinite versus finite games. If you realize that, there are two types of games, there's infinite and finite games, and you realize that trading is a finite game. It's an infinite game, not a finite game. And when you think of trading as a finite game, that's when you struggle. That's when you get stuck in the mud because you're constantly trying to get winners. But guess what? Trading is not about winning. Winning doesn't get you anywhere in terms of a portfolio. It's about cutting your losses and making sure you think long-term about the long-term growth of your portfolio. The only way that can happen is by reducing risk. So great conversation, Patrick. I think it's worth continuing to explore. And I think this is a theme that both you and I need to continue to talk about, as we deal with, as we teach investors on how to succeed in trading. But I do want to move on here because we have limited time. And I do want to talk about the US dollar versus Canadian dollar, because, we've seen this weakness in the dollar index, but we haven't seen a lot of weakness in the dollar in comparison to the dollar CAD recently. It's still trading around that 133 level. Thoughts on that? Do you see dollar CAD moving lower here over the next few months, especially as you look at interest rate differentials? Canadian markets looking substantially stronger from an interest rate differential. I think those models are pointing to a significantly weaker US dollar versus CAD.
Yeah, well, the Dixie, the dollar index is like 57% weighted to the euro. And so when we were looking at that dollar trade earlier, it really has and especially when you take into account the Swiss and the pound and all the other currencies in there, the European component is really big. While we generally see that the major currency crosses all kind of move against that dollar, the dollar is the primary trend and all these currencies move against it. Really, the Australian dollar and the Canadian dollar have very much a commodity driven spin on them, which they need a second component working, which is that there needs to be some really good momentum in the commodity space, which is often driven by global growth, right? And so during periods where the global economy is recovering, and so I think for the Canadian dollar to really get some traction, we would need to see that the global recovery story becomes very clear, that the COVID recession is rear view. The economic data continues to improve globally, particularly even in emerging markets and areas like this. And if commodities start to reflect it, copper going north of 3, all the other oil, let's say, continuing to recover, that's where I think Canadian dollar has the potential to do much better. And if that doesn't emerge, and let's say the recession gets worse, and all of the and commodities end up losing a lot of their momentum, like you were talking about, oil potentially breaking to the downside, all of those things would be massive headwinds that will drag the Canadian dollar to underperform the Dixie. And so or at least as a cross, it would. But I'm not so sure that there's such a global recovery going that the Canadian dollar will outperform. So I think that more of the same is what you should expect.
Okay, that's fantastic insights. And the dollar CAD is at a pretty, what I would say, significant line in the sand around 134 here. You know, strong resistance for a long time, broke out, and now providing support multiple times here around 134. So Patrick thinks that it's going to be more of the same, around 134, 136, 135 in that area. I just from interest rate differentials, my view is more seeing a bit more strength here in the Canadian dollar. 2-year yields in Canada is about 26, 27 basis points. US is at 11 now. So we're talking almost 3 times the yield from a Canadian 2-year bond versus US. And that's part of why I think that you're going to see a little bit more strength here in the Canadian dollar. But I do hear your point about, commodities being a big driver of the dollar CAD.
Just to be clear though, like I don't disagree with that. I actually just don't think the Canadian dollar will, let's say, outperform the euro, I don't think that this is where the money flow is going to, where there'll be an outperformance of the currency unless the global growth story actually really starts to gain some traction.
Okay. Well, I really appreciate your insights here on a macro perspective, but let's shift our focus a little bit here on more of the Canadian market. So, we saw a pretty big jump here in Cannabis growth reporting earnings this morning. From my perspective, not a big earnings announcement, $110 million in revenue, still a fairly large loss, but obviously the loss a little smaller than what investors are expecting. Still hasn't, broken out from the trading range here. And as we know, Cannabis has been underperforming for quite a few years now to the downside. Any thoughts here on the Cannabis market? Is this one that you trade yourself?
Well, I mean, I've been watching it. I don't have any positions in it at this moment. But the one thing that we can sort of identify, it's sort of, I would equate it a lot to what mining stocks went through for multiple years, where it kind of the sell-off ends, but the bull market doesn't begin. And it's like an extended purgatory of trade range where the stocks are trading now far closer to their fair values, but there isn't a catalyst for the bull phase to really kick in. In fact, I would argue that this becomes an interesting stock from an income writing perspective, from an options income writing. While it's sitting in a very choppy, sideways, range-bound environment, the higher implieds on these types of stocks may offer a very reasonable percentage return on something that probably is done selling. I mean, I don't know whether a new catalyst emerges for taking it lower or not, but I would assume on balance of probabilities that it's probably going to be far more range bound, which makes it for income harvesting, it's a reasonable thing. What numbers are you showing there?
So this is, I think you bring up a very good point. And for those of you that follow OptionsPlay, we send you these income reports. The marijuana companies always end up at the top of the list here. So if you own 100 shares of Cannabis growth, which will cost you roughly $2,400 Canadian at the moment, to sell a September $32 call, that's a call that's almost 40% out of the money, will collect you 50 cents in premium, but that's 2% of the underlying stock price in just 40 days. That annualizes out to about 19% yield on a stock that pays no dividends. The yields on these type of stocks are extremely attractive. And you can get a little bit more aggressive, right? So if you think that this is more range bound, maybe you might be inclined to sell a $28, $29 and you'll collect 80 cents. That's 3% of the underlying stock price in just 39 days. Those are some hefty income numbers to receive off of a $2,400 investment.
Yeah, you can pretty much get 8-9% right at the money. If you want to just go forget about capital appreciation, I'm just going to play the income writing game. and you just roll your covered call, I mean, that's some pretty robust premiums for a stock that's been doing nothing.
Yeah, absolutely. So, and I completely agree with you on your views here in terms of the marijuana companies, just from a fundamental perspective, and the technical chart reflects it as well. There's just absolutely nothing interesting about this from a growth story perspective. You know, the 2.0 in Canada, where they're selling edibles now, that only contributed $7 million in revenue this particular quarter. This is a full quarter of sales. So nothing, in my opinion, here that looks particularly interesting for the turnaround story just yet, as far as marijuana stocks. And lastly, just before we sign off here, Patrick, I just want to get your thoughts here on today's rally here in financials, specifically the banks. You know, the banks have struggled. It is the second worst performing industry behind energy. You know, interest rates obviously keeping a fairly tight cap on this particular space. You know, from my perspective, I do have some concerns about this recent rally here, similar to the rally that we saw here back in early June, as to whether it's sustainable or not, especially with interest rates, you know, heading to zero. Any thoughts here from a bigger picture on the banks?
Well, you know, I'll tell you what I'm watching. Like from a technical perspective, almost every junior technician sees this as a breakout. Often you take these trades. I mean, I'm not even going to say not to take it, but the one thing that I'll be watching for is does the smart money sell into the rally? Sometimes you get these breakouts and they become like false starts. And then the breakout, which attracts a lot of technicians to that, then those that have too much exposure start unloading into that. And so what actually would be the big canary in the coal mine would be if the strength was immediately reversed within the next 24 to 48 hours. I think the big thing to watch, that breakout candle from this morning, is whether it sticks. And so I think that's the project to watch for the next 2-3 days, is that will it follow through? Will it trigger more buying and begin a feedback loop of positive price action that actually, you know, starts that off to heading to like $80 on the upside? Or do we find that it completely fades the rally within a day or two, and then that's a red flag for me for sure.
Yeah, and keep in mind that, and and I completely agree here. My hunch is that this could be a bit of a breakout that fails. And you do have a pretty tight breakout here from the past couple of, I would say, 3 to 4 weeks, where it's traded within this kind of wedge. You got a little bit of a breakout, but you do have this all-time high here. This is BMO, right? But the chart here looks very similar to pretty much any of the Canadian banks. BMO was one of the big movers here today, up over 1%, almost 1.5%. But you do have that pretty big resistance level around that 58.5. So, you know, I suspect that you're going to get to that level, maybe a little higher, and fail, just because I don't think the macro and the fundamentals support you know, a real big move here, especially from the major banks. I could be wrong, but you know, that's why I think the best way to play this, in my opinion, is to use limited risk strategies like a vertical spread here. So September 76.82 call spread here costs you $2.05, and just to put that into perspective, $2.05 on a $76 stock is only 2.6% of the underlying stock's value. So I'm risking only 2.6%, even if the Bank of Montreal reverses all the way down to the low 60s. I'm only risking 2.5% of the stock price to place this type of breakout play. If the breakout does sustain and continues to rally, then I'll roll that up maybe to a higher strike price, or you know, the different options that Patrick and I discussed as far as rolling it up. So with that, that covers what I wanted to talk to you guys today about, and I'm so glad to have Patrick coming on board and giving us his views from a macro perspective, as well as his views on marijuana and financial companies. So before we wrap this up, Patrick, I'll just give you a couple of minutes to tell everyone here, you know, how they can find out more about you if they want to continue the conversation with you, whether it's through big picture trading, and if you have a particular link, I'm happy to put that into the chat window so everyone can follow up after we finish here today.
Oh, for sure. Well, it's no particular link. I mean, you could put just bigpicturetrading.com on there to share with everybody. But we have a 2-week free trial to Big Picture Trading that you can access at any point. And particularly one thing that we're doing right now, which is so important, is we've been long these leaps on gold and silver for a very long time. And into the strength, one of the really neat things about the gold and silver market is that they have very rich call premiums, which allow you to build asymmetric collars to lock in gains on them. And it's not common to see that, because most stocks have left fat tails, which is rarely do you have a scenario where the call premium will pay for the put. And what's interesting is you can build a lot of very low cost to zero cost collars on the gold advance and and silver advance. And so we're focusing a lot on that on silver. So if you want to look over my shoulder and see how we're doing it, you're welcome to try out a free trial.
Well, thank you so much, Patrick. Thank you so much for joining us and sharing your insights. I hope everyone here enjoyed that. I hope you guys all have a great afternoon. And I really hope this was helpful in giving you guys a better understanding as to our views here in the market. And if you don't already have access to OptionsPlay, which is a tool I just showed you here to look at option strategies, whether you're looking to speculate on a directional view on a specific stock or ETF, or if you're looking to generate income like Patrick suggested here for some of the Cannabis, some of the marijuana companies, you can do that all through OptionsPlay, and that's free of charge, courtesy of the Montreal Exchange from OptionsPlay.com. So thank you so much. I hope you guys all have a great Monday. I will send out the recording with slides to everyone after we finish here today. And a big thank you to Patrick for joining us today. So I hope everyone has a great trading day, and I'll see you guys here next week.
Thanks a lot, Tony. Thanks, everyone.
Thank you, Patrick.